Hi everyone. I wanted to give you the latest housing market update for San Diego County. And if you're in other parts of the country, maybe you'll find some value in this too. What you have to understand is that real estate is a slow moving train. And we don't have all the answers overnight, but what I'm going to do is I'm going to take April's data and extrapolate from there, as April was the first calendar month that we've had since the coronavirus outbreak in mid-March. The other thing I want to do is show you specific differences that between what led up to the housing collapse in 2008 in San Diego County versus what we're going through today. So check this out. Let's start with our new listings in April, or how many folks put their home on the market in the month of April. As you can see here, new listings were down by 41% versus April of last year. And it's my feeling that the sellers that went on the market in April, such as some of the ones we are working with, signed contracts earlier in the year, so I expect these numbers to worsen in May. Homes that actually closed in April were down 32% from this time last year. And once again, I believe this number reflects those homes that went into contract earlier in the year, so I anticipate closings to be lower in May. I predict that homes that will sell in the month of May will be at least 40% lower than the same time last year, based on the amount of homes that went into escrow in the month of April. In total, only 1,980 homes went into escrow in April, which, by the way, is our 7th worst month since 2004. The worst month was December 2007 with 1,372 escrows. All right, so in my industry, I'm basically an old dog because I started in real estate sales and finance back in 2002, and I've been through the boom, the bust, the rebound, the slowdown, and now the shutdown. So naturally, I'm going to draw comparisons from 2008 versus today, and here's what I've come up with. Our median sales price at the height of the market in 2007 was $500,000, and it took about 20 months for it to lose 45% of its value. And from there, it took us about another 8 years to crawl back to $500,000. The median value for this April actually ticked up a bit from March, and I'll cover some reasons for that here in a minute, but a lot of this has to do with supply and demand, and the other part of it has to do with sellers affording to hold out on their pricing. June of 2007 was the market's peak leading up to the crash. And at that time, San Diego County had 25,000 listings on the market and only 2,700 sales. In March 2020, we had 5,200 homes on the market, and ironically, we also had a little over 2,700 sales. As you can see here, going into the Great Recession, we had nearly 5 times as many homes on the market, or 11 months of inventory, compared to 1.8 months of inventory today. So you know, anything over 6 months of inventory is considered a buyer's market, and anything under 6 months is a seller's market. So what else is different? The Fed and 30-year mortgage rates. Going into 2007, the federal funds rate was at 5.25%, and the 30-year fixed rate averaged around 6.35%. Going into March of this year, the Fed funds rate was at 1%, and the 30-year averaged 3.5%. Leading up to 2007, the Fed was raising rates to curb inflation, and the byproduct was adjustable rate mortgages resetting to higher payments, which turned into a domino effect that created the meltdown, and so on and so forth. Going into this shutdown, inflation was in check, and the cost of homeownership was actually more affordable today than it was in 2007 when you base it on the 30-year fixed rate mortgages. As you can see here, a mortgage in 2007 at the peak of the market of $500,000 would cost you $3,100 a month at 6.35%, which was a going rate at the time. It is still more affordable to own a home today with rates at 3.5% and the median price at $600,000 than it was in 2007. And according to our Housing Affordability Index, in 2007, only 10% of families could afford to buy a home in California versus 31% today. That's exactly why lenders came up with adjustable rate mortgages, to make it more affordable in early 2000s for folks to buy a home, but that's a totally different topic for a totally different time. So to wrap this up, I'm not sure exactly where Zillow and Fannie or other institutions are coming up with their value predictions, because the truth is we don't know where values are heading at this point. What we do know is that there is a lot more motivation now to keep folks in their homes, both external with banks and internal with equity. Banks don't want to foreclose, so you see the foreclosure moratorium and forbearance programs, and homeowners don't want to give up their home equity. This is a positive scenario to prop up the market, and typically a homeowner that has equity is not going to lose their home to foreclosure if they're forced to sell. They have equity so they can still unload it on the market. Here's what I'm keeping an eye out for right now. If unemployment continues to rise for a prolonged period of time and we see a spike in bankruptcies, that will in turn push folks to have to sell their homes. You see, up to this point, very few folks had to sell. For the most part, they took advantage of the higher market or needed to relocate, but they weren't in distress. But if folks can't pay their mortgage and they have to sell, then we'll see a wave of homes hit the market when this opens back up, and that pressure will push prices down. But I have more faith in our recovery today than 2008, and I definitely do not see a 45% drop in home values. For now, folks are sitting in place. April's numbers tell me that owners aren't dropping prices yet because they believe this will pass, and they'd rather pull their home off the market until it does. But we're definitely in a Mexican standoff with COVID, and we're gonna have to wait and see what the damage is. And for our clients, all I can do is promise to be transparent and continue to keep you updated as we get through all this. Stay healthy, and God bless.